What if I told you that the market's recent dip isn't a crash, not a crisis, not the end of the rally, but simply smart money quietly taking profits before the next big move? Imagine watching prices climb for weeks, maybe even months, and then suddenly, a pullback. The headlines scream, "Gold loses momentum." Analysts on TV look worried. Social media turns negative overnight. But behind the scenes, something very different might be happening. What if this small drop is actually the calm before a powerful surge in 2026? And what if the biggest opportunity is hiding right inside this moment of doubt? Welcome to the Gold Report, where we break down what's really happening in the gold market in simple, clear language. If you care about protecting your money, growing your wealth, or just understanding where gold prices could go in 2026, you're in the right place. And before we go deeper, take 2 seconds right now to like this video and subscribe to the Gold Report. It truly helps the channel grow, and it makes sure you never miss an update that could impact your financial future. Let's slow this down and think clearly. Gold has always moved in cycles. It doesn't go straight up forever, and it doesn't collapse without reason. Every major rally in history has had pullbacks. Every strong bull market has moments that scared people out before the next leg higher. In 2026, the question is not whether gold will move. The real question is why it will move, how strong that move could be, and who will be ready. Right now, we are living in a world that feels stable on the surface, but uncertain underneath. Inflation may not be as explosive as it was 2 years ago, but it's not gone. Interest rates may have peaked, but they are still historically high. Governments continue to carry massive debt, and central banks around the world are quietly increasing their gold reserves. That last point is very important. When central banks buy gold, they are not trading for short-term profit. They are preparing for long-term financial protection. The role of the Federal Reserve is central to this story. For years, low interest rates made gold less attractive because investors could earn yield elsewhere. But as economic growth slows and rate cuts become a possibility in 2026, gold suddenly looks more attractive again. When rates fall, the opportunity cost of holding gold decreases. That's when institutional money often starts flowing back into precious metals. Now, let's talk about something that rarely makes headlines but matters deeply. Global trust in currencies. The US dollar is still strong, and the United States remains the largest economy in the world. But trust is not static. When debt levels rise and geopolitical tensions increase, countries start diversifying their reserves, and that's exactly what we've been seeing. According to data published by the World Gold Council, central bank gold purchases have remained historically high. That is not random. That is strategic. Let's bring this into 2026. If rate cuts begin, or even if markets strongly expect them, gold could experience renewed upside momentum. Large institutions like Goldman Sachs and JP Chase often adjust their gold forecasts based on macroeconomic shifts. And when big banks revise targets upward, retail investors usually follow. But here's the key difference. Smart money positions early, before the headlines change. Picture this scenario. Early 2026. Inflation stabilizes, but doesn't fully disappear. Economic growth slows slightly. Equity markets become more volatile. The New York Stock Exchange sees bigger daily swings. Investors who felt comfortable in risk assets start looking for stability. Gold doesn't need panic to rise. It just needs uncertainty. And uncertainty is something our global system has plenty of. Another powerful force in the gold market is demand from countries like China and India. These are not small players. They represent massive populations and strong cultural demand for gold jewelry and savings. When their economies stabilize or grow stronger, gold imports tend to increase. That steady physical demand creates a floor under prices. It's not speculative. It's cultural and structural. Now let's talk about the psychological side. Markets move on emotion as much as logic. Fear pushes prices up fast. Confidence pushes them down slowly. In 2026, if global investors feel even slightly nervous about equities, bonds, or currencies, gold becomes a natural hedge. And here's something many people forget. Gold is not just a crisis asset. It's also a portfolio diversifier. Big funds don't wait for disaster. They allocate percentages of their portfolios to gold as insurance. There's also the role of the International Monetary Fund, which constantly monitors global debt levels and economic risks. When debt to GDP ratios rise across multiple nations, the long-term value of fiat currencies becomes a serious conversation. Gold, unlike paper money, cannot be printed. That simple fact alone gives it a unique position in times of monetary expansion. Now imagine being an average investor watching all this unfold. You see headlines about slowing growth. You hear talk of possible recessions. You notice central banks quietly increasing reserves. And then you look at gold prices pulling back slightly after a rally. The question becomes simple. Is this weakness or is it opportunity? Let's go deeper into price structure. In every strong bull market, gold tends to make higher highs and higher lows. Pullbacks often test previous support zones before moving up again. If in 2026 we see gold respecting those higher support levels, that would confirm underlying strength. It would suggest buyers are stepping in consistently. And that kind of pattern attracts even more capital. Another factor that could influence gold in 2026 is the real interest rate. Real rates are calculated by subtracting inflation from nominal interest rates. When real rates are low or negative, gold becomes very attractive. Even if nominal rates remain somewhat high, if inflation stays persistent, real returns on cash could shrink. That environment historically supports gold prices. Let's also consider geopolitical risk. Global tensions do not disappear overnight. Trade disputes, regional conflicts, political elections, and shifting alliances all add layers of uncertainty. Gold doesn't need a global crisis to move higher. It simply reacts to increased risk perception. Even a small spike in tension can create sharp short-term rallies. But I want to be very clear. Gold will not move in a straight line in 2026. There will be volatility. There will be sharp drops that scare people. There will be moments when commentators declare the rally over. That is normal. Markets test conviction. The strongest gains often come after periods of doubt. Think back to previous cycles. When gold broke major psychological levels in the past, momentum accelerated quickly. Once new all-time highs are established and sustained, technical traders jump in, algorithms trigger buy signals, media coverage increases, retail investors rush back, momentum feeds momentum. Now, let's imagine a more aggressive scenario. Suppose central banks not only continue buying, but increase purchases in response to global currency concerns. Suppose rate cuts come faster than expected. Suppose stock market volatility spikes due to corporate earnings pressure. In that combined environment, gold could see a powerful breakout phase in 2026. Price targets that once seemed unrealistic could suddenly become realistic. On the other hand, let's be balanced. If inflation drops sharply, growth rebounds strongly, and real rates remain high, gold could trade sideways for a period. That would not mean the long-term story is broken. It would simply mean the catalyst is delayed. Gold is patient. It moves when conditions align. One important element many people overlook is mining supply. Gold production does not increase rapidly. It takes years to discover, permit, and develop new mines. That limited supply growth creates natural scarcity. When demand rises suddenly, supply cannot immediately respond. That imbalance pushes prices higher. Another factor is exchange-traded funds that hold physical gold. When ETF inflows increase, they must purchase actual gold to back shares. That adds immediate demand pressure. In 2026, if retail and institutional investors return to gold ETFs in a big way, the impact on price could be significant. Let's talk about the emotional journey of an investor in 2026. At first, you might feel uncertain. You hear mixed economic data. Some experts say recession, others say soft landing. Gold moves up, then down, then up again. It feels confusing, but over time, a pattern begins to form. Higher lows, strong rebounds, increasing central bank support. Gradually, confidence builds. This is where patience becomes powerful. Many people chase price spikes. Few people build positions during consolidation phases. The difference often shows in long-term returns. Smart investing is rarely about excitement. It's about positioning before the crowd fully agrees. Now let me ask you something. If gold breaks into new highs in 2026, will you look back at today's small pullbacks as missed opportunities? Or will you feel confident knowing you understood the bigger picture early? That's exactly why we created the Gold Report. Not to create hype, not to create fear, but to help you think clearly, stay informed, and make calm decisions in a noisy market. As we move closer to 2026, keep watching three things: central bank policy signals, real interest rates, and global risk sentiment. If these align in gold's favor, the upside potential could surprise many people. And remember, major moves often start quietly. They don't announce themselves with fireworks. They begin with subtle accumulation. Before we wrap up, I want to hear from you. Do you believe gold will reach new all-time highs in 2026, or do you think the market will stay range-bound? Drop your prediction in the comments below. Your opinion matters, and I read every single comment. If this analysis helped you see the market differently, share this video with someone who follows gold or cares about financial security. The more informed we all are, the stronger our decisions become. And once again, make sure you're subscribed to the Gold Report so you never miss what could be the most important gold cycle of this decade. 2026 is not just another year. It could be a turning point. Stay patient, stay informed, and I'll see you in the next report.